Hi friends, this is Vinay. Welcome back to Simplifying Stock Market. Today in this video, we are going to learn about operating ratios. Operating ratios are also called as activity ratios or asset management ratios. These ratios indicate efficiency of a company in both operations and utilization of its assets. Investor must compare these ratios not only with companies belonging to the same sector but also to be analyzed with past years' historical data of the company before investing. The first operating ratio is fixed assets turnover ratio. It indicates how much revenue is generated by a company with respect to its investment in fixed assets. Fixed assets turnover ratio is equal to operating ratio divided by total average assets. Higher fixed assets turnover ratio means high efficiency and it is a positive sign to an investor. Company which is well established may not invest in fixed assets year on year, but a growing company may invest in fixed assets year on year. The next operating ratio is working capital turnover ratio. What actually working capital means? Working capital is the capital required by a company for its day-to-day operations. If a company's current assets are financed by current liabilities, then working capital is equal to current assets minus current liabilities. If working capital is positive, it means company has surplus working capital and it can easily manage day-to-day operations. If working capital is negative, it means there is a deficit of capital, hence they take a debt or a loan to run day-to-day operations of the company. Hence, such a company is risky for an investor. Working capital turnover ratio is the ratio that indicates how much revenue a company is generating for every rupee of working capital. Working capital turnover ratio is equal to revenue divided by average working capital. Say if working capital turnover ratio is equal to 5, it means the company is generating 5 rupees for every 1 rupee of working capital. Chief Financial Officer of a company manages the working capital of the company. And the next operating ratio is total assets turnover ratio. This ratio indicates the efficiency of a company to generate revenues with the existing assets. Total assets turnover ratio is equal to operating revenue divided by average total assets. Higher total assets turnover ratio means the company is performing well. Say if total assets turnover ratio is equal to 2, it means for every rupee of asset, company is generating 2 rupees of revenue. Therefore, higher total assets turnover ratio is a positive sign for an investor. The next operating ratio is inventory turnover ratio. But what actually an inventory mean? Inventory means manufactured goods or products that a company maintains in its warehouse to sell in near future. If there is a huge demand for the products of a company, then the inventory gets frequently cleared and volume of manufacturing is maintained accordingly to refill the inventory to meet the growing demands of their products in the market. For example, say company A manufactured 10,000 mobile phones. But all mobile phones cannot be sold at a time and company needs to wait for some time before going for further manufacturing. So their inventory capacity is 10,000 mobiles. Assume it takes 2 months to sell these 10,000 mobiles. It means every 2 months company turns over its inventory. Therefore, in an year, company turns over inventory 6 times. Higher inventory turnover of a company implies higher demand of their products. Inventory number of days. It refers to how much time a company takes to sell goods present in the inventory and make money. If lesser is the inventory number of days, then it is a positive sign for an investor. It means the products of the company have a good demand in the market. Inventory number of days is equal to 365 divided by inventory turnover ratio. Inventory turnover ratio is equal to cost of goods sold divided by average inventory. The next operating ratio is accounts receivable turnover ratio. This ratio indicates how many times in a specific period a company receives money from its dealers, consumers, and users, etc. Higher accounts receivable turnover ratio implies more frequent money collection. Accounts receivable turnover ratio is equal to revenue divided by average receivables. Next operating ratio is days sales outstanding ratio. This ratio indicates average cash collection period between billing and collection. If more frequently cash is collected by the company, then it can use the money in production and other activities quickly. Days sales outstanding ratio is equal to 365 divided by accounts receivable turnover ratio. For example, say a company's days sales outstanding ratio is equal to 35. It means the time period between bill generation and collection of money is 35 days. That's all in this video. In our next video, we shall learn about valuation ratios. Thanks for watching. Goodbye.